Welcome to the deep dive. Today we're really getting into the details of JSW Infrastructure Ltd. They're India's second largest private port operator, a major player.
Absolutely. And our mission today is pretty clear. We want to cut through the noise from their latest results, Q1 FY26, plus their earnings call, investor slides, board meeting info.
Exactly. We want to help you understand what's really driving this company and, what it means for India's whole infrastructure scene.
And we've got the goods to do it. The official media release, the earnings call, transcript, the full thing, their presentation, board outcomes, it's all here.
We'll distill it down for you.
Precisely. Get you the key takeaways without drowning you in jargon.
Okay, let's start where you always start. The money, the financials. JSW Infra's Q1 FY26 consolidated numbers. What's the headline?
Well, the headlines look pretty good, actually. Total revenue hit 1,314 crore. That's up 19% year-on-year.
Solid growth and operational revenue.
Even better, in percentage terms, 9,224 crore, up 21% compared to last year.
And the bottom line, profit after tax, the PAT.
That's where it gets quite impressive. 390 crore, a jump of 31% year-on-year.
31%, wow.
Yeah. But what's maybe even more striking is how financially stable they look. Their net debt to operating EBITDA.
Right, the leverage ratio.
Exactly. Over the last 12 months, it's just 0.54x. That is incredibly low.
Especially for ports, right? That's a hugely capital-intensive business.
It really is. You need massive upfront investment. So a number like 0.54x, it's almost unheard of. It signals really strong financial discipline.
And it means they have room to move.
Loads of room. Financial headroom, dry powder, as they say. They can chase new projects, handle market bumps, maybe even outpace competitors who are, more leveraged. It's a serious strategic plus.
That makes sense. And sticking with financials, you mentioned discipline. There was an interesting point on expenses. Employee benefits were down.
Yeah, a noticeable reduction. Management said it's part of a continuous trend, quarter on quarter, and most sort of one-off charges are already in the books.
So does that mean they're getting more efficient? Streamlining things?
It certainly raises that question, doesn't it?
Mm-hmm.
You also had depreciation at 143 crore consolidated, and finance costs were 91 crore.
Okay.
But interestingly, those finance costs included a 36 crore unrealized gain, the mark-to-market thing, due to INR changes and yield curve shifts.
So not a cash impact, more an accounting adjustment.
Pretty much, yeah. But it shows how currency can affect the numbers on paper.
Mm.
So you put strong operations together with this tighter cost control.
And you get
a healthy return on capital employed. For the trailing 12 months TPM ROCE, it was 14.7%. So for you listening, the picture is growth, yes, but smart growth. They're making their capital work hard.
Okay. Strong financials established. Let's look at the core business, the ports, the actual operations. Total cargo handled.
29.4 million tons in Q1 FY26. That's up 5% year-on-year.
5%. Decent. What drove that?
A lot of it was coal. Strong performance at Ennore, PMP, Paradip coal terminals. Plus, good contributions from Southwest Port and Dharamtar.
Any new contributors?
Yeah, the interim operations at Tuticorin and the JNPA liquid terminal also chipped in.
But it wasn't all up.
No, there was some offset.
Yeah.
Lower volumes at the Paradip iron ore terminal and a little dip in third-party cargo, specifically at Jaigarh.
Yeah.
But that brings us to a really key strategic point.
Which is?
The third-party mix. Cargo from customers outside the JSW group.
Ah, okay. How did that perform?
Even better, actually. Third-party volumes grew by a strong 8% year-on-year.
8%, so faster than the overall growth.
Exactly. And that pushed the share of third-party cargo to a record 52% in the quarter, up from 50% a year ago.
So over half their business is now non-group.
Right. And that's not accidental. The very deliberate strategy to diversify, reduce reliance on the anchor client, it makes the whole business more resilient, less tied to one specific industry cycle.
Makes sense. So the core port segment itself, revenue is up 8% to around 1,086 crore. EBITDA up 9% to 561 crore. Margin ticked up slightly too.
Yeah, to 51.7%. And management sounds pretty confident. They reiterated their guidance for 10% volume growth for the whole of FY26.
Even with the 5% start.
Yeah, they pointed out that the second half is usually stronger, H1 gets hit by monsoons, and apparently July trends are already looking positive.
What about specific ports, like Dharamtar and Jaigarh? You mentioned slightly lower recent growth there.
They expect that to be, quote, lumpy. It's tied to steel capacity additions by their main customer. But the target for those two combined for the full year is still ambitious, 45.8 to 46 million tons. Better than last year, driven by more iron ore imports.
And Goa. Any updates there?
They've got the consent to operate the CTO for 11 million tons per annum, and approvals for another 4 Metipod to get to 15 are currently being processed.
Okay. And prices? Did they manage to increase rates?
Yes, realization per ton was up about 2% year-on-year, mainly price hikes in Goa and at coal terminals, plus some automatic adjustments based on the wholesale price index, the WPI. Those usually happen in Q1.
So this growing third-party share, careful price management, it points towards a more diversified, maybe less risky future growth path.
I think that's exactly the takeaway, a healthier, more balanced business model.
Okay, let's shift gears now. From ports to logistics. The Navcar Corporation turnaround seems like a big story this quarter.
Oh, definitely. Navcar was acquired relatively recently, and the results are, frankly, quite impressive, a real recovery story.
Okay, break it down for us. Volumes.
Exim cargo, that's export-import containers, hit 81,000 TEUs. TEU is the standard 20-foot container unit. That's up a huge 31% year-on-year.
31%.
Yeah. And domestic cargo was 275,000 metric tons, up 11%. Strong volume growth across the board.
And the financials for Navcar.
Revenue climbed to 138 crore, up 17%. Here's the kicker, EBITDA. A year ago, Q1 FY25, Navcar's EBITDA was just 2 crore, a tiny 2% margin.
Okay, low base.
Very low. Now, Q1 FY26, EBITDA is 20 crore. That's a 15% margin, huge improvement.
15% margin, that's much healthier.
And the net profit, it went from a 13 crore loss last year to a 2 crore profit its quarter.
Wow, lost a profit in a year.
Yeah.
That's a swift turnaround. What drove that? Integration?
Effective integration, strategic focus, operational improvements. It looks like a combination. They also mentioned the Morbi ICD hitting a key benchmark.
Right, the ICD. Maybe quickly explain what an ICD is, and maybe CFS, too, for listeners not deep in logistics jargon.
Sure. An ICD, Inland Container Depot, is basically a dry port. It's like a seaport, but located inland. It handles container storage, customs clearance closer to factories or markets. Think of it as extending the port's reach inland.
Got it. And a CFS.
Container Freight Station. That's usually near a port or ICD. It's where less than container load cargo gets consolidated into full containers for export, or where imported containers get deconsolidated for different buyers. Both are vital cogs in the logistics machine.
So the Morbi ICD hitting over 5,000 TEUs a month is a sign it's really working efficiently now.
Exactly. Achieving critical mass, better empty-loaded ratios, meaning fewer empty container movements, which cost money. It's all pointing towards operational efficiency.
So given this Navcar success, what's a bigger vision for JSW Infra in logistics?
It's ambitious. They reckon that even with current Navcar assets, if they run at 80–90% utilization, they could hit 850 crore in revenue. Maybe even 1,000 crore if they add more rakes, trains.
And for this financial year, FY26?
The guidance is around 700–800 crore revenue for logistics, aiming for about 100 crore in EBITDA.
But long term?
Much bigger. By FY 2030, they've earmarked 9,000 crores and a lot of capital just for logistics expansion. The goal, an 8,000 crore top line with chunky 25% EBITDA margin and aiming for a top-tier ROCE.
8,000 crore revenue from logistics alone.
That's the plan. So it's not just about adding another business line. It's about building an end-to-end service, ports plus logistics, making their offering stickier for customers.
Okay, that brings us to the really big picture, the overall growth blueprint. This is where the scale gets pretty staggering.
It really does. The headline target is to boost cargo handling capacity from the current 177 million tons per annum MTPAR to 400 million TPAR.
400! That's more than double.
Yes. And the target date is FY 2030, or potentially even sooner, backed by a massive Euro 30,000 crore CapEx plan over that period.
30,000 crore, huge numbers. How are they planning to get there?
It's a mix. New greenfield projects, expanding existing brownfield sites, and strategic acquisitions. Let's unpack some key projects. First, the Kolkata Container Terminal.
What's happening there?
They got the letter of award to reconstruct berth 8 and mechanize berth 7 and 8 at Netaji Supay's dock. It's a DBFOT, contract design, build, finance, operate, transfer.
Meaning JSW takes on the whole project lifecycle for a set unit.
Exactly. 30-year concession. They build it, run it, then hand it back. CapEx is estimated at 740 crore, capacity around 6.3 million DPI, or 0.45 million TEUs. Should be done by Q2 FY28. It's a key move into containers for them.
And improving connectivity seems key, too. The Boak Railway siding near Jagar Port.
Yes, they signed a binding MOU with Konkan Railway for that. This is crucial. It gives Jagar proper railway access.
Why is that so important?
because it allows them to move all sorts of cargo containers, bulk, liquid, much more efficiently to and from the hinterland, the areas inland from the port. It makes JAGAR much more attractive, especially for third-party customers. Turns it into a real multimodal hub. Expected completion in 1.5 to 2 years.
That focus on rail links ties into another interesting move, acquiring NCR rail infrastructure through insolvency. What's the significance there?
Well, buying through insolvency can sometimes mean getting assets at a good price. But the real value here is strategic. NCR Rail has a private freight terminal in Khurja, Uttar Pradesh.
Location, location, location.
Absolutely. It's near Delhi, near the upcoming Johor airport, and critically, close to both the eastern and western dedicated freight corridors, the massive new rail freight arteries.
So a key node in the network.
Precisely. For 467 crores, they get a terminal with rail lines, warehouses, land. It's a vital piece for building that pan-India logistics network they're aiming for. Use group cargo as a base, capture return cargo, maximize efficiency.
Makes sense. Okay. Beyond upgrades and acquisitions, what about brand new port, Jatadhar Port in Odisha?
That's moving ahead. Anchor customer signed a concession agreement in June. It's a 30 middle T-pay project, 3,000 crore capex, civil contract placed, dredging started.
Timeline.
Completion targeted for March 2027. And importantly, it has assured cargo coming from a big slurry pipeline project that connects to it, starting April 2027. That really de-risks a new port build.
And another new one, Kini Port in Karnataka.
Yes, another greenfield project. All-weather, deep-water, multi-cargo. Concession signed last November. Capex is around 4,119 crore.
In the status there.
Public hearing is scheduled for August this year. Construction is expected to take about 3.5 years, so commercial operations aim for FY 2029. These are long-term foundational builds.
Any quick updates on other ongoing projects? JNPA Liquid to Corin?
JNPA Liquid Terminal handled some interim cargo in Q1, completion expected very soon, within Q2 FY26. Tuticorin also handled interim cargo, completion now eyed for Q1 FY27, slight delay linked to when the final LOA came through.
And the Jigar LPG terminal?
Targeting completion during FY 2027. There were some past delays getting PSO approval. That's the Petroleum and Explosive Safety Organization. Safety clearance is vital for LPG.
Great. And finally, a couple of expansions mentioned.
Yes, Mangalore container capacity going up from 4.2 to 6 middle TIPA, and a big one at Dharamtar and Jigar, 36 middle pay expansion, driven by the anchor customer steel capacity growth. That's another 2,359 crore capex, targeting March 2027 completion.
So pulling it all together, these specific projects, big and small, are the building blocks for that 400 middle TIPA vision.
Exactly. It's a complex, multi-year plan involving greenfield, brownfield acquisitions, connectivity, and they're still actively evaluating upcoming port privatizations, like more terminals at Kolkata and Paradip. The growth appetite is clearly there.
Okay, so with all this focus on massive expansion, steel, concrete, how does sustainability fit in? The ESG side, environmental, social, governance.
It seems to be a significant focus, and they're getting external validation. They got an A rating, which is leadership grade, in the CDP Supplier Engagement Assessment. That's a respected global benchmark.
Any other recognition?
Yeah, Dharamtar Port won a Global Environment and Sustainability Award. And their Paradip terminals were named Best BOT Operator by the Port Authority there for the third year running. These aren't just PR wins. Good ESG ratings can attract investment and strengthen their license to operate.
And they track specific metrics.
They do. For Q1, they reported numbers for energy consumption per ton handled, greenhouse gas intensity, water usage, waste recycled, 45.8% recycled, which is pretty good, and renewable energy generation.
And the essence in ESG, the social side.
They highlighted community initiatives impacting thousands in areas like health, education, water, sanitation, waste management. It shows an integrated approach.
And on the G governance, there was a new board appointment.
Yes, Mr. Rajiv Kumar, appointed as an additional and independent director. His background is quite notable.
Tell us more.
Master's from Harvard, former IAS officer, retired as Chief Secretary of Uttar Pradesh. He was the first chairperson of the UP real estate regulator, UP era.
So deep government and regulatory experience.
Exactly. And critically, he was shipping secretary in the central government, additional secretary in petroleum, joint secretary in finance. Huge experience in industrial development, infrastructure regulation. He's been on boards like Indian Oil, GAIL.
So bringing someone like that onto the board, what does that signal?
It brings invaluable expertise for navigating regulations, managing government relations, and providing strategic oversight, especially given their massive expansion plans and reliance on concessions and partnerships. It strengthens their governance significantly.
Okay, so wrapping this up, we've done a pretty thorough deep dive into JSW Infrastructure's Q1 FY26. The picture that emerges is strong financials, impressive operational growth, especially that shift to third-party cargo.
Right. And a really clear, incredibly ambitious plan for future expansion, covering both ports and integrated logistics.
So here's something for you, the listener, to think about. Considering this aggressive expansion, the strategic moves into logistics, the sustainability focus, how might JSW Infrastructure's evolution reshape India's supply chains?
Yeah, and its international trade competitiveness over, say, the next decade.
Yeah.
What wider economic ripples could this create? Something to mull over.